All right, thank you everybody for joining us today for a very important podcast. Louis, if you can kill the stream on your side. And we're going to talk about startup management through the COVID-19 crisis, brought to you by GS Capital and L2 Council. And before we jump in, we'll give you a quick agenda and introductions on us, your speakers today. So we will cover the macro environment, what to expect in startup land, how startups should be responding, the legal considerations, and at the end we'll do Q&A. We'll ask you to use the Q&A function to ask your questions. We have a lot of people in this webcast, so that will be a good way to manage that. So I will kick it off. My name is Vitaly Golub. I'm a technology venture specialist with a variety of experience on all sides of the table. I'm the co-founder and managing partner of GS Capital, where I help growth stage transportation and mobility and AI companies raise capital, exit through M&A, and advise enterprises on corporate innovation, venture capital, and acquisitions. Previously, I helped launch HP Tech Ventures, the corporate venture arm of Hewlett-Packard. I grew up in Cupertino, California, and started my technology career as a teenager. So before going to the dark side, I founded 3 technology companies and in graphic arts. And for the last decade, I've spent quite a bit of time as an accelerator mentor and business school guest lecturer. I wrote the best-selling startup manual, Accelerate Startup, and I keynote on startups, venture capital, and corporate innovation at many conferences around the world. And I'm the Silicon Valley representative and supervisory board member of the Ukrainian Venture Capital Association. My background is in computer and video imaging, and I studied venture capital at UC Berkeley Haas School of Business. And I also happen to be a FINRA licensed broker dealer. So over to you, Louis.
Wow, I'm Louis. I'm also like Vitaly, a local boy. Grew up in the Berkeley Hills. My office is now in Palo Alto, and I'm often in San Francisco and all over the Bay. I'm a startup lawyer, and I help companies get formed, get structured properly, get financed, and scaled for growth. And I spent a lot of time helping great startups plot exciting exits, and I look forward to meeting and talking with you today. More about me on my website, l2council.com. Vitaly?
Thank you, Louis. So before we start, slides and the recording will be sent out after the webcast. Please use the Q&A function, and you have our emails here, and we'll repeat it at the end as well. So diving right in, if we look at the macro environment, quick tour of what's happened in the last couple of weeks here. In the US, monetary policy and quantitative easing, government bond buybacks, interest rates to zero. On the health side, obviously shelter in place in the US and around the world. $2 trillion stimulus has passed as of last night or this morning, which will distribute direct payments and jobless benefits and money to states, bigger than their annual budget. It is the biggest fiscal stimulus in human history. It is a $500 billion bailout for distressed businesses, paid leave, free testing and aid for families, $1,200 in direct cash payments with incomes up to $75,000 and phasing out after $99,000. $130 billion going to hospitals, $150 billion going to state and local governments, and $350 billion going to small business loans. So that's kind of our context. And if we look at how all of this has started to spike, as the news was about to break about the outbreak and it began trickling out, stock markets around the world began to react. Now, as investors have become quickly more risk averse, we're likely headed for a consumer, corporate, and sovereign debt crisis. If we look at consumer debt, despite an increasing savings rate in the last decade, US consumers have accumulated now more debt than the previous peak during the housing bubble, or just before the housing bubble in 2008. And US corporate debt now also exceeds the prior peak at the housing bubble. And despite the good times, many countries have run up their debts over the last decade with deficits while their economies were growing, which now leaves them in a very precarious position to deal with the recession. Italy not only currently has the worst health effects of the outbreak, but with a debt to GDP ratio of over 130%, looks particularly vulnerable economically. Italy's economy is expected to contract by at least 3% this year, and Italy's banks are poorly capitalized and cannot extend credit to borrowers, and they own about a quarter of the country's 2.4 trillion debt. So this makes a recipe for an economic disaster. Italy is the 8th largest economy in the world. For comparison, Greece, which caused the last sovereign debt crisis about 10 years ago, is 10 times smaller. So Greece and Portugal are also vulnerable given their high debt to GDP ratios and relatively low growth. So banks all over Europe hold substantial amounts of Italian government debt and would also feel the consequences. So at this point, it's unclear how long the economy will be on lockdown and how deep the financial crisis may be. This has the potential to have a much harder impact on consumers, corporates, and governments as they find themselves in a far more expensive credit environment. So now a little good news. Governments and central banks understand this, and this is why you're seeing such fast action to provide liquidity and debt relief at all levels. This means that we may have learned some lessons of the past, and we may avoid a depression or even something like a great recession. So we're still in a very vulnerable state, and much will depend on how quickly we're able to return to close to normal levels of business post-coronavirus. Obviously, we're now going into a recession. Top economists polled by the Chicago Booth Initiative for Global Markets predict a major one. And interestingly, the European economists are more pessimistic than the American ones. Of course, we know that the impact of this shutdown will affect all industries, some and a few very severely. I posted a short guideline for those looking to restructure their investment portfolios the other day. And this applies, of course, to startup founders when they're looking at their own businesses as well. So companies with cash on the balance sheet have a far better chance of weathering the storm without massive changes. Big tech largely falls into this category. Companies with high fixed costs, low margins, high debt are at a very serious risk of going under. And I'll remind you that bailouts do not help equity holders. They get washed out. E-commerce, companies like Amazon will consolidate their gains as retails get slammed and people change their behaviors and get used to it. Companies with variable expenses like those in the sharing economy will shrink with reduced demand, but come back. And luxury goods brands that survive will be depressed for some time. Travel and hospitality will be most hurt by those, but those that survive will have more market share in the end. The recovery, however, is expected to be slow and painful. If we look at the restaurant segment, essentially restaurants have flatlined and been forced to lay off their staffs. A few are doing deliveries, and Travis Kalanick's new Ghost Kitchens business, designed to be the warehouse of food delivery, seems to be a pure genius move in retrospect. That was just started not long ago. And as households make adjustments to their spending, we will see a wave of durable goods sales like cars fall off a cliff. To return only when consumer confidence does. So we can look at what happened in China with automotive sales in February for some clues.
So it's a good time to buy a car, Vitaly?
Yes, you will see a lot of sales for cars. If you haven't started getting emails yet, you will probably next week with a lot of dealerships running really interesting lease deals. So as we know, most things are manufactured in China. Supply chain is a major aspect here, including approximately 80% of medications consumed by Americans. And now we're seeing factories and logistics companies come back online, but shortages are being felt, particularly given that the extreme demand on medical supplies. And many manufacturers and logistics companies didn't survive the shutdown in China, so others will have to pick up the slack, but they will be hesitant as they're watching the rest of the world go through the crisis and are trying to ascertain demand. We will see this repeat across other world manufacturing and raw materials hubs as well.
Vitaly, we have a question from the audience, whether we think there's anybody who's going to gain from the recession.
Well, e-commerce, certainly. Let's come back to the Q&A at the end. I think we'll cover a good amount of these aspects, but as I mentioned, e-commerce is certainly an area, and anything online will consolidate its gains and get a chance to prove itself. The labor market will be quite unequal and will change forever as well. So highly skilled are likely to be able to work from home, but this is not an option for most. Approximately 29% of Americans are the lucky ones. They're knowledge workers, educators, financial service professionals. But the health workers, drivers, cleaners, retail clerks, besides grocery, supply chain, and construction workers are not so lucky. This correlates with forced unemployment for entire categories of workers and will only exacerbate the income inequality problem that we've already started noticing, of course. Now, perhaps some good news can be found in companies that have moved towards remote working. They may be more accepting to work from home in the future, as it provides flexibility, convenience, lowers costs, and congestions in cities. On the education side, according to the UN, more than 770 million students are affected by the closures. Studies show that this is likely to negatively affect learning outcomes. As many schools and universities have gone to distance learning for the remainder of the school year, this provides a massive opportunity for digital learning to prove itself. And this will disproportionately affect children in low-income families, since not everyone has access to the internet or the computer equipment to make this effective. Many low-income families also rely on schools to feed their kids on weekdays. So it has some other effects as well. Now, without launching into a deep economic theory lesson here, we can ascertain that, and the economists polled by the Initiative of Global Markets agree that there will be a battle between supply and demand that will ultimately lead to a large contraction of what's called the economic surplus, or in other words, the size of the economy. Economic effects from reduced spending will have a larger effect than the supply chain disruption and illness-related workforce reductions that are more immediate. So the recession is here. Uncertainty, panic, and lockdowns are driving a large drop in demand. With a drop in demand comes a drop in cash flows and the inability for small businesses and consumers to spend. Large drops in demand force business closures and layoffs, further dropping consumption, and this feeds a depressing loop. However, if we take a look at the economic history at the time of the Spanish flu in 1917 and 18, it infected 500 million people, which is more than a quarter of the world's population then. It killed 100 million, which is about 5.6% of the entire world population. And this is much more lethal than COVID-19. The economy entered a recession in 1918 and started recovering when the virus ran its course in March of 1919. The stock market at the time went down 35% in 6 months. We did it much faster this time. And it only took then 18 months to get back to its previous level. So you can make a case that we'll recover faster this time. We have some very aggressive policies happening. There's a massive, obviously, difference in medical practices and advances in the last century. And ultimately, we will have a vaccine. So it is possible that the 2020 timeframe will be compressed and we will see a relatively quick recovery. So going now on to what to expect in Startupland as we zoom in. First of all, expect a slowdown in business and declining revenues. Many businesses are essentially shut down right now, given both supply chain disruptions and worker quarantines. Just as you're reducing your spending, so are your customers. And if you have sales-driven business model, expect to miss your previous targets in the short and medium term. Nothing is certain, as deals you were sure you're going to close last month may be delayed and canceled. So expect the unexpected. Though we can be confident that startups are the engine that will continue to thrive and generate value for the foreseeable future, you will have to adjust your expectations. This is driven by uncertainty, and the question for many investors is, of course, why should I buy something today that will be much cheaper tomorrow, right? That is what uncertainty is. The Great Recession was the worst recession since the Great Depression, and venture investing only decreased about 28% between 2007 and 2009. Early stage startups that have money in the bank to get through the next year or two are particularly well positioned. They will seek exits in 5 to 10 years, and in the meantime will have lower costs and less competition. Growth stage companies with proven unit economics also stand to benefit. However, in the immediate term, late stage investing will be impacted as exits through big M&A and IPOs will of course be delayed. For example, you may have, of course, heard that Airbnb has changed its tune recently, and instead of planning to go public this year, they're planning to raise a round and hunker down. This will also shake out both the emotional hobbyist angel investors on one side and the private equity funds and soft banks of the world experimenting with later stage investments, later stage venture investments from that side as well. Now, there's a slowdown in venture activity already here. As we can see by this graph, since October of last year, we've basically seen activity cut in half. Louis, maybe you want to cover some of the bullets here.
Yeah, so before this call, I kind of did the round of the general counsels at the various venture capital firms that I know across the country, and uniformly we've heard of and we're seeing term sheets being pulled by existing leads, particularly where the round was perhaps discretionary or where valuation is questionable. So anything in the hospitality sector right now obviously has to be challenged. And the valuation reestablished. I think some firms are assessing their whole portfolio given the changes in the market, whereas they might previously have contemplated liquidity in some portion of their portfolio in a certain time period that would allow them to put money back to work. Or that they would be spending a certain amount in a certain period. They're no longer thinking that their previous assumptions are necessarily still valid. We're hearing that corporate strategics are still moving ahead mostly, not pulling deals and holding tight. I think as Vitaly noted, the data shows that VC investments made in periods like this are the investments that drive the greatest return. So I definitely expect to see VCs, continue to be very active in the market, write term sheets and close deals. I just think that the terms upon which we were seeing deals get done at the end of last year are going to be very different than what we're going to see once the market stabilizes. And I'll make a happier note that the stock market had its best day in history yesterday, and it continues to drive up as the minutes go by of this call. So that's really excellent news. I would expect to see in the venture market where companies need money to instead go for a convertible note term sheet, a bridge note, and to force everybody to come to the table. I think that we're going to see a lot of pay-to-play rounds to make sure that there aren't any free riders. So a pay-to-play, for those of you who don't know, is a round where if you're an existing investor and you don't take your pro rata, you get converted into common and you get washed out. So it's kind of a hammer to force people to come into a deal and support a company. So we're now, I think if you can price around and proceed with equity, that's better than the convertible note, because the convertible note is going to have a discount, and if valuations are going to go down further in the venture market, the discount on a lower valuation is going to be fairly punitive. So I think the decision about whether to take a convertible note term sheet right now is a tough one that deserves a lot of careful thought. So that's what we're seeing across the world of venture, Vitaly.
Thank you, Louis. And we also have some statistics also from this tech general counsel survey from this morning about what's happening in growth companies, just so you can benchmark yourself against what others are doing, right? Over half have closed offices worldwide. Almost half have mandated work from home policies. We have suspension of all domestic work travel for about a third. Only 3% received positive COVID-19 tests. That's probably good. 8% of employees waiting test results now, and interviews are now in a virtual environment. Delays in hires, requiring temperature checks. And I personally think that we're going to see similar kind of to a post 9/11 effect, where the new normal will be, measuring temperature and all sorts of safeguards coming into big office buildings and government buildings going forward, right? That's not just going to be for a little while. Work from home meal reimbursement is also happening in small minority. It's an interesting idea, as well as equipment and furniture purchases. And some are also providing a childcare stipend. This is tough for a lot of working folks. Have two adults working from home and a house full of kids doing distance learning.
Vitaly, I haven't seen a lot of great statistics on cuts in employment and cuts to contractors and suppliers, but I think that's obviously something that's happening. And for those of you on the line who are suffering from that, my heart goes out to you. For those who are responsible for making sure your company makes it through, this is just a time where you've got to make some very tough decisions to make sure that you're being responsible with the cash that you have on hand, and you stretch it out as far as possible. And so if there are some folks on the bubble, if there's a business opportunity that's not core to what you're doing that's on the bubble, I think your boards are going to expect you to come and propose some hard decisions. Some other companies that we're seeing are not laying off employees; they are furloughing them, on the theory that they're just not needed right now because their customers are closed. So why would you keep your sales force working? So there are a lot of creative ways that companies are trying to get through this period, and we're here to help. Vitaly?
Thanks for that. Yeah, absolutely. And I'll come back a little bit to some ideas on what you should be doing and how to treat labor forces. We don't have statistics yet, but the expectations are pretty dire as far as number of layoffs. The numbers will be pretty eye-popping when they do come out. Now, let's talk a little bit about what's happening in M&A deals. Louis, if you want to touch on this as well.
Yeah. So again, I see the deals that I see. So I have my own perspective, but I called around some of the major strategics and private equity buyers over the last couple of days to get ready for this call. And I think it's very fair to say that M&A deals have softened and have slowed down. Many deals are being renegotiated. The terms are becoming incredibly buyer favorable. Rep and warranty insurance, I have heard, is getting tougher to price and tougher to get done. And we're all seeing the inclusion of a COVID-19 provision, which says that whatever the effects of COVID-19 are excluded from that rep and warranty policy. Now, one interesting seller response that we're seeing is what we call the COVID-19 qualifier, and some sellers are including in their documents a provision that says that if any of the reps or warranties become untrue between signing and closing due to COVID-19, that the buyer is to assume the risk. And obviously, some buyers will see that clause and flip it around and say, "No, seller, you assume the risk." And obviously, that's a question of leverage. Among the private equity buyers, we first saw, I would say, in February, a renegotiation of terms. And at this point, we're seeing just private equity firms pressing pause. And the theory there is that it's just not responsible for them to put their LPs' money to work in an environment where the VIX is as high as it is, and where there's a question as to what are the fundamental valuations that these companies will go for after the new normal is established. And so we're seeing just a lot of private equity buyers pause, and strategics for the most part proceeding, all just slowing down and citing COVID-19 as a reason to reschedule meetings, and that internal processes are being delayed. And that seems like a reasonable response. If you go to the next slide, Vitaly, some terms to watch for if you're in the middle of a deal, or some terms to think about. Most M&A agreements have some sort of a purchase price adjustment mechanism to account for the working capital in a business at the time of closing. So it's just current assets minus current liabilities. And if you think that your cash is going to burn faster, or if you're not going to be able to build the same amount of receivables, or that your payables are going to climb up, you really ought to be thinking about what's the right peg to establish the working capital bogey, and then what plan for what kind of an adjustment that there might be at closing. There's a lot of focus on force majeure clauses in customer supplier contracts. So in due diligence, you should expect a lot of hard questions from buyers about the integrity of your business, really, and whether your customers are canceling contracts citing the COVID-19 and force majeure clauses. People are wanting to understand what insurance is available for COVID-19. Any new insurance is going to exclude it, but if you had existing coverage, buyers are going to want to know if insurers can help stand behind the business. There's a lot of focus on cybersecurity and employee due diligence and buy-side processes right now. You should expect timing delays, obviously. As a result, for both buyers and sellers, I think it's really important to push the outside date out further than you otherwise would to account for delays that we just can't even imagine today. A lot of people are asking me whether a MAC clause can get triggered for buyers to be able to walk away from a deal. There was a famous case in the 1960s where a buyer had agreed to buy a sugar refinery in Cuba, and Fidel Castro, between signing and closing, nationalized it and took control of it. And the buyer said, "Hey, I shouldn't be forced to close because, there's been a material adverse change. There's no way I could ever take possession of that sugar refinery because Fidel Castro is there with guns." And so the court said, "Okay, that's a material adverse change." And there have been very, very few cases that we can point to that gives any definition to what a material adverse change would be. But I think that there is a view that it would have to be significant in duration, meaning more than a year, and it would have to be specific to the target and not to an entire industry. And so there's a view that COVID-19 should not be a trigger for material adverse change. Finally, Vitali, in a buy-side, sell-side process, there's typically a period between signing and closing during which the seller is subject to very tight operating covenants. They have to get the buyer's permission before they do certain things. And I think sellers are going to need some flexibility to respond in whatever ways are necessary to the evolving COVID-19 pandemic. So whether it's making or pushing out hiring decisions or rolling out new programs, they really need some flexibility to respond to the crisis. Vitali?
Yeah, there was a good question in context here. I'm kind of monitoring the chat. What kind of due diligence are you seeing on the employment side?
Great question. I think people, from an HR perspective, who's really needed. And from a compliance perspective, is what's going on right now complying with law? So did you legally lay people off if that's what you did? Did you legally furlough people if that's what you did? And did you notify people properly? That kind of thing. Good question.
Very good. And for those of you that joined late, we will make the slides and video available after the webcast. Now, getting back to a few other points here on what to expect in Startupland, there will be less demand and therefore lower bids for online advertising inventory. So this is good for you if you're the one doing the online advertising, and it's bad if you're the one serving the ads. Office space will become reasonable again as many companies evaporate and others decide that remote work is quite an acceptable or preferred alternative. There will be less competition for talent. This will reduce the biggest line item early stage startups have and subsequently lower their capital requirements to a healthier level. There have been a lot of complaints in the last decade by all sides about these factors. And again, remember, some of the greatest tech companies were started in the toughest economic periods. HP was founded near the end of the Great Depression. Google and Salesforce started right at the as a dot-com bubble burst. Uber, Instagram, WhatsApp, Airbnb, and dozens of the other unicorns were started in the Great Recession. Startup funding has grown tremendously in the last 15 years. Internet penetration and speed is growing to levels unimaginable a decade ago. Everyone with a wallet has a computer in their pocket and can spend money in one click. And 5G will create a whole new generation of opportunities in tech. So with declining birth rates and aging population, we will rely on technology only more in the future. The other thing is VCs have raised record funds in the last year or two, and will need to put the capital to work. In turn, their LPs have little places to put more money in, especially in the zero interest rate environment that we find ourselves in now. So just don't expect the same valuation numbers as you saw last year and the year before that. So net, if you have a startup providing value, a valuable service, good unit economics, and in a sector that's relatively unaffected or even luckily has suddenly become much more interesting and aligned with changing customer behaviors, you should be very optimistic. You need to be disciplined and focused through this period of uncertainty because we don't know how long it'll take. And of course, you need to save money. So let's move then to some of the suggestions on where you should be putting your attention these days. And then we'll jump into legal specifics as well. So obviously you need to cut costs immediately. If you need to do layoffs, do them deeply and do them early. Make sure you have as long of a runway as possible so you can give yourself the best chance to make it through this period of uncertainty. John Chambers recently said that leaders are born during times like these. So your teams, your customers, your vendors are looking for confidence in you. Develop a consistent message of stability and transparency to communicate to them. Your teams need your leadership, compassion, and motivation now more than ever. They are all nervous and scared. Many have families to take care of. Many have little or no financial cushion. Some may become sick. Remember, loyalty goes both ways. So now is the time to show yours to them. And if you have to lay off employees or contractors, make sure to take care of their needs to the best of your ability. It is a good rule of thumb for startups to delay hiring until it hurts generally, and to remain very cash conscious. It's time in times like these, especially. If you haven't already, revisit all of your budgets and adjust for this new reality. Do more with less. Expect that you will not have an investment or the same level of revenue for a while. Revisit all of your unit economics and assumptions. As they say, cash is king and conviction is queen. So this is also the time to look for new opportunities in the market. If you're in an industry that benefits from this crisis, such as online education, remote work, online entertainment, now is a good time to be investing. Also, if you're generally sitting on a lot of cash on your balance sheet and a lean cost structure, lucky you, you can take advantage of lower customer acquisition costs while others are moving slowly. And you may even be able to acquire weaker competitors at this time. So time is not to just hunker down, but really think about your individual situation. So Louis, over to you for some more legal considerations.
Yeah, I mean, I think that I've noted that we are seeing some investors back out of deals. A lot of you are going to have your convertible notes terming out, meaning that you're going to hit your maturity date. And, you know, you ought to be thinking about agreeing to extensions for those convertible notes that are going to term out during 2020, because you should expect that you won't be able to raise equity. I don't think that's necessarily true, but I think that's what you got to plan for. I think, you know, as we talked about, you've got to take a really hard look at, you know, your stakeholder base and which employees are mission critical and which are on the bubble, and make some tough decisions. Probably you're going to do the same thing with some of your vendors, and realize your customers are going to be doing the same thing to you. If you're in a regulated business, you know, I would spend a lot of time and energy on the phone with your regulators to make sure that you know ahead of time what's coming down the pike. Those are kind of some high level thoughts. I want to talk a little bit about you know, managing your workforce, and I don't know if that's supposed to be on this slide or the next one, but I'm gonna hit it here. You know, we as directors or managers of companies, we have a general duty to take all reasonable measures to protect the health and safety of our workforce and to provide a safe place to work. And so if you haven't already told your employees to go home wherever you are, you ought to really think about that. You've got to consider the workspace that you provide to your employees, and you know, how it would even be possible for you to guarantee their safety. And so you know, if it's you know, when I go to the Safeway, I don't see the checkout clerks wearing masks, or I am starting to see them wearing gloves. So I think that's good. But, you know, I think they're, depending on what your business is, you know, can you have them in the office or not? And if you are having them in the office, what are you doing to protect them? So providing masks and gloves and deep cleanings overnight, I think is something to really think about. Take a look at your benefits plans and make sure that your employee base, those that have covered insurance, have access to testing. I want to say a word about communications. I think it's really important to communicate often at this time and with confidence. I think your stakeholders are looking for you to, especially now, to communicate with confidence and clarity. Hopefully, you had a preparedness plan. Hopefully, you've told folks that travel is not a smart idea right now, and you've put a stop to that, not only for cost reasons but for safety. And I would try and open it up to general questions and make sure that you're collecting those questions and you've got somebody that's running down the answers to those questions, whether it's from your insurance carrier or otherwise. Next, I wanted to talk about some tips on managing the remote workforce, and I think you ought to, companies would be smart to have some policies written down and widely communicated on how to do this, with regular updates and reminders to folks as to what those are. If not all employees are allowed to work from home, I think you ought to have a system for them to make the request and for you to respond. One difficulty about working from home is tracking the hours, particularly for non-exempt employees, as you could be hit with overtime claims later. And I think if you have a good written policy, that should help. You may need to consider what folks' reasonable business expenses are to set up a home office. Tell your employees how to protect confidential information at home. I think that's very important. And, some tips for employees and employers who cannot work remotely, social distancing, alternative work and shift schedules, and managing access to the workplace to ensure employee safety. So Vitaly, back to you after my litany of recommendations there. And again, we will circulate these slides with some of these details filled in after the program.
Thanks for that, Louis. So we are now going to tackle some Q&A. And I'm going to flip over to the next slide, which also has some resources and our contact information. Don't pull the triggers yet on the emails, but let's go through a few of the questions here. So let's see. I'm trying to pick through them quickly while I do this. Let's see, Louis, maybe you can answer, how will M&A activity be impacted as it relates to debt markets? Have you seen a lot of companies pulling from borrowing to do M&A on your side? Maybe it's a question I should be answering more.
Great question, and we're absolutely seeing that the debt markets have pressed pause. So if your deal requires debt financing, expect delays. And I think that the capital is still there, and I don't think the capital is frozen. I think the problem is that acquisition financing typically requires at least negative covenants and sometimes even financial ratios. And I think there's not a lot of confidence on what those corrected financial ratios ought to be, Vitaly. And more than that, I think the seller, the lender, the borrowers really need to think long and hard about the business model that they provided and whether they still can stand behind it and whether they want to adjust it so that it conforms to reality. There is nothing worse than having provided lenders with a rosy scenario that doesn't pan out. And if you miss your numbers in a material way, your loan will end up in the workout group. And that is not a good place to be. So definitely seeing a slowdown in deals that require financing. But I do believe with the Federal Reserve pumping so much money into the economy that the money's going to be there. It's just going to be making sure that we all understand what the rules of the road are going to be.
Very good. And I think this is one we can answer from both directions, both on kind of strategy as well as a legal side. What happens if a convertible note turns out, but you do not have the cash to pay them back? So let's tackle the legal side first, the different options there, and I'll talk about strategy after.
Yeah, no. If your note is a secured instrument, expect that the lender can go swoop in and enforce the security interest and take possession of whatever property you have. Now, most convertible note investors are not investing with the goal of taking possession. Most convertible notes are not secured, so really it becomes a negotiation of what terms are they going to demand in order to roll over those notes for another 6 months or a year. Are they going to demand more interest? Are they going to demand a steeper discount on conversion, or are they going to demand a lower cap on conversion to compensate them for the risk of holding the paper for the extra time? In my experience, 99 out of 100 of these things get rolled, or if they don't get rolled, they just don't get enforced. And that's generally what I see. Vitaly?
Yeah, I would suggest one more thing on top of that is that you certainly know the dates of your convertible notes, and you need to look 6, 12 months ahead and start talking to your investors and make plans. It's better to have discussions early and quickly, to have some optionality at the table, and to look ahead and show that you're mature CEO trying to deal with the situation and not run away from it. You'll find, obviously with convertible notes, once upon a time, these were instruments that looked closer to debt. These days, they're really for early stage investors, and the investors are really investing not to, like Louis said, take possession of any of your assets. They're looking to kind of binary way to get involved with the company. So you'll find that most investors will be very understanding, and will try to work it out with you. At the very least, try to extend the terms. We can certainly talk to you offline if you have a special situation that we might be helpful with.
Yeah, Vitaly, I
Let's
wanted
see.
to add one more note, while we're on the topic of convertible notes. My good friend Ed Zimmerman out of New York published a blog post the other day that I thought was really interesting, and that's whether or not you should take a new convertible note versus a price round. And if you think that the market is going to be going down, and if you think that your equity value is going to be a down round from the current round, doing a priced round today is probably better than doing a convertible note, which will have a discount off of a lower valuation. In other words, really think of the cost of capital and what makes the most sense. And if you can get an equity deal done now at today's price rather than a convertible note, you would potentially serve yourself well, unless of course the note's going to stay, they're going to give you enough cash to ride out the storm for 2 years. Most bridge notes don't work that way, however. They are punitive, and they're designed to get you to raise equity as soon as you can, and so maybe a priced equity round is in fact the right way to go. Vitaly?
Yeah, I would definitely agree on that. It's better to have some certainty right now. Again, I mean, if you look at the history, on the one hand, there's some positivity to look at that this may be a V-shaped recovery, maybe a quick one. It really depends on second wave and how quickly we have therapeutics that work for this virus and kind of reduce the health risk out there and let everybody get back to normal. On the other hand, we may be past the point of no return to a certain degree, and there's too much debt, and we've already gotten into this depressive feedback loop, so it may get stretched out. So it's always better safe than sorry. Make sure that you have enough cash in the bank. Make sure you have some kind of a cushion as much as you can do it. And don't try to over-engineer rounds. That's my normal advice. Don't try to over-engineer rounds, because while you're trying to do that, the investor is going to lose interest anyway. So especially now, this is the case. Let's see. So another question here on, let's see. There was a question on LPs. So question, if LPs, limited partners and venture funds, if they will meet the capital calls. So I think it would be useful to talk about that for a second. So let me kind of make a quick note and hand it over to you, Louis. So LPs that don't meet their capital call commitments will usually lose the interest in that fund. So that's a pretty big risk, unless it's a fund that just got organized last month and there have been no investments made yet. in which case you will see people backing out. Running to public equities, that was the other part of this question, for lower risk. These are generally different investment strategies, different allocations. So people are not going to, professional investors are not going to make huge changes in the way they invest and run from venture capital into the public markets generally. So Louis, maybe you can talk a little bit more about the legal ramifications of LPs dishonoring capital calls.
Yeah, and I have not heard that phenomenon has begun. I did, when I was doing the rounds of the last couple of days, talking to folks, confirm that nobody's reported to me a default by an LP. But I think the more relevant trend that we're seeing is that venture firms and private equity firms, they want to go back to that LP in the future, and they're constantly in touch with their LPs, and the whole art of fundraising is to be in constant contact with your LPs and making sure that they're happy with your strategy, with the portfolio, and that you're giving them positive updates. And so venture firms are needing to show their LPs that they're reacting to the environment, that they're being careful, that they're not being silly with the LP's money. And so I don't expect to see aggressive deals. I don't see VCs or PEs feeling like they can stretch themselves to reach a higher valuation to get a deal done. And so I would expect much tougher terms out of financial investors as they manage their relationships with their LPs and demonstrate to them that they're being careful. I remember back in 2008, there were a lot of LPs that instructed their private equity and venture firms, please do not call capital for the next 3 months. We would like you to see you press pause, reevaluate what the market looks like, and I'm not hearing that yet, that LPs are demanding that financial firms press pause, but I think there's a bit of an anticipation of that, and firms are being careful. Vitaly?
Yeah, I think within a couple of weeks, we're going to start seeing people settling into the new normal, and you're going to see some adjustments like this. There was a question here also, what are the key lessons we learned from dot-com bubble and from the Great Recession of 2008, 2009, to help those in an entrepreneurial ecosystem to be smarter in the current environment? That's the thing, is that you need to understand that this is not a speed bump. This is a brick wall for a little while. There's no reason for you to wait to see what happens. You need to make immediate adjustments to make sure that your company survives this. That's probably the most important kind of general piece of advice I can give. And of course, situations vary, and every company has its own calculus to make. Let's see, there was something about, so the other question is, should new startups not look for capital, for funding right now, even if they have disruptive technologies? There's two ways to answer that question. On the one hand, great truly disruptive technologies that have a long view will always have willing investors. Right now, there's a little bit of chaos going on for the last couple of weeks and the next few weeks. But as things settle down, you're going to see people starting to look at new deals again. Right now, most VCs, most investors are mostly focused on deals that were already in process, and of course, supporting their portfolio companies and making sure that they get through this period of uncertainty. So,
Vitaly, I want to make a small plug for the Small Business Administration, the stimulus bill only got passed in the middle of the night, and I haven't read it. But I believe that there is going to be significant non-dilutive capital available for early stage companies. They're calling them groans or grants that look like loans, but they won't require a personal guarantee, and thus some non-dilutive capital on pretty favorable terms available. And so I would look very carefully at the SBA, as well as whatever your state or local equivalent of that is. I think the government's going to put a lot of money to work, and it would be great if you could find a way to take advantage of that for your company.
Yeah, absolutely. SBA loans, I've written about that in previous email blasts. That's going to be something that startups qualify for in a lot of cases. Let's see, there was another slightly more technical question. What type of covenant terms are you seeing, Louis?
Well, I think that really depends on the security. So I need more specificity to answer that.
Let's say if we can generalize anything as far as equity investments or any kind of convertible instruments.
I don't think we can draw any conclusions at this point.
Okay, fair enough. Let's see. And there was a question about expectation of the real estate market. So this is also good news, bad news. The good news is that there'll be something like 3 to 5 trillion in money being printed in the US, which will create some inflation. We also have very low, zero interest rate environment. That means mortgages are low. So that will somewhat support residential real estate, in my view, to a certain degree. We'll see. It'll be different areas will respond differently. And commercial real estate obviously is in big trouble. And then also attached to that, fintech, right, as a separate category. Fintech, so if it enables some kind of e-commerce or remote commerce, that will be a positive. Anywhere where you can remove friction will be, I think, helpful. Anything you want to add on that, Louis?
Nope, I think you nailed it.
Okay. And let's see, going through, okay, how is private healthcare practice market being impacted? Any thoughts on healthcare market? What you're seeing, if you're seeing any jumps?
No, I think that anybody that's developing vaccines, again, I'd be looking to the government for money first before anybody else, because that would be non-dilutive capital. I've got an interesting vaccine company that I'm working with, and that's the path that we're going down is government funding and collaborations with state universities, and getting uses of labs and things like that. Trying to be smart with how we grow the business. Other sectors I see as a question is, what other sectors are we seeing getting a lot of traction other than e-commerce? That's a good question. I don't know if I want to answer that one. Vitaly?
Yeah, I mean, it's generally, I think it's pretty obvious where things are either enabling technologies or applications for enterprises and consumers that enable kind of some kind of normalcy remotely. I think those are areas that are acute right now. But again, by the time you gather everything, and if you don't happen to be aligned with one of those categories, you're not going to have a whole lot of time to come up with a new startup, in the next couple of weeks that will be fundable in this category. Getting back to the healthcare question, I am seeing a lot of companies in healthcare. There's a lot of noise. There are companies that haven't had a lot of attention in the past year or two or more that are all of a sudden a lot more interesting because there's generally more investor interest in the healthcare market. But when the noise fades, you're going to see that it's going to get, again, quite specific on what's interesting and relevant in healthcare and what's not. Certainly, I think generally the environment is pointed at, healthcare all of a sudden became something that everybody became really familiar with and really interested in. And it's a hot topic, as well as now we understand and everybody truly feels what the term crisis really means. And I think long term, we're going to see, one of the positive effects is that when we talk about climate crisis, people are going to start paying attention a little bit more as we get through this one and thinking about what that might mean in the future. So that certainly supports the electric vehicle market. And now as supply chains come back online and reconfigure, you're going to see an acceleration, I believe, in EV adoption and going in those directions, because it just won't make sense to go back to kind of doing things the old way to a certain degree. So I think that's a net positive. So let's see, maybe a couple of more questions. I want to go kind of to the top of the hour and let everybody get back to their days here. So let's see. So Uh, let's see. So refocusing. See, are people agreeing to deferred comp for employees who take an interim pay cut? How does this work? Any ideas on kind of on the employment side, how to structure this?
Yeah, no, that's a great question. And I think first off, if management teams would be, thoughtful to take an axe to their own compensation before they do that for the rest of the workforce. And so I'm aware of a number of clients that have where the management teams have announced that they're going to go without salary. I always try and correct them that they need to pay themselves at least the California minimum wage. Otherwise, you have compliance issues and to pay the payroll tax on that. The good news is that payroll tax has been deferred. And if you pay your workers, I think there is a permanent holiday on payroll tax for people that are on sick leave or some other kind of leave due to the COVID-19 crisis. There's also a 90-day delay on tax payments, so that's a helpful move by the government. But yeah, you want to make sure that whatever you're doing is in compliance with employment laws, which are very complex and both in terms of labor law as well as tax law. Tally?
Yeah, so just maybe last set of questions as far as kind of broadly looking at luxury markets in general, the sports industry, and the price of oil. So let me try to hit those three, and then Louis, maybe you can add your perspective on that, and then we'll go through our closeout here. As far as sports market, what's been most interesting for me is that esports became a thing. So Formula One went to essentially a virtual Formula One and experimenting with that. So that's quite interesting that kind of this merger of esports, that this may be esports moment. Will sports recover? I think people, that's something that people have been doing since hunter-gatherer days. So I don't think that's going to change with a little blip in the big context. We'll get back to business. Unfortunately, the Olympics are moved to next year, but it could be worse. As far as the price of oil with EV, I think if this happened 10 years ago and the oil tanked like it did, that would certainly hurt those early EV sales. I don't think people are so driven by the cost of fuel anymore in their EV choices. So I think that's a positive. And then, of course, luxury market, two ways to answer that. From my perspective, there will be a big shutdown right now. Neiman Marcus just announced they're seeking bankruptcy protection. They are over leveraged and PE owned right now. So you're going to see a big drop, but the ones that survive will revive at some point, and luxury brands have been around for a long time, and people will go back to those habits as well. Louis, anything else you want to add on that?
Well, for those of you in the audience that are in the M&A space, or with companies that needed to do a transaction this year, I think that we're going to need to be thinking about a little more broadly about how we accomplish a sale of a business, whether it's in parts or the whole, and whether we take advantage of the bankruptcy courts to get free of some debt and do 363 sales. And so I, for one, am polishing up my restructuring M&A textbooks and war stories and looking at articles from 2010 to remind myself about what I was doing in those days. I think that later this year we'll see a lot of that. And I think they're going to be great deals to do in this market, and I'm real optimistic in closing, Vitaly. I think people are handling the crisis really thoughtfully, and I think that there are going to be some fantastic opportunities that result. We've got a great stimulus package from the government, which is going to put cash into the hands of consumers as well as loans in the hands of small businesses like startups. I think that the fiscal response, the monetary response from the Fed has been incredibly constructive, and they've really preemptively made sure that the credit markets don't freeze up and that capital will be available to do things. And I'm really excited and uplifted by the response of the medical and life science community in terms of how to get ready for this. And I think there are populations on this call where COVID-19 is going to get a lot worse. I'm in Palo Alto, where we're kind of one of the clusters of where a lot of the COVID-19 cases have happened in the U.S. It's going to get worse before it gets better, but I'm pretty excited that we're on the right track, and we're all in shelter in place and practicing social distancing and washing our hands. And I think that good things are going to happen as a better response evolves.
Yeah, I would definitely echo that sentiment that there's a lot of positive things that will be happening moving forward. We just need to survive through this speed bump, and the important thing is for you to look at your companies or your portfolio companies if you're on the investing side, and make sure that they have enough cash to get through this. So with that, I want to thank you very much for joining us. Wanted to share some resources that we found useful out there and informative. We wanted to share our positive outlook and kind of an extreme focus to do the right things, the disciplined things right now to make sure that great companies survive and thrive through this period. If you are a revenue generating company looking to raise capital or explore a sale, or are an enterprise on the enterprise side looking in, please reach out to me. And likewise, if you're looking for great legal support from one of the most experienced corporate attorneys, and my good friend Louis here in Silicon Valley, please reach out to him. We'd be happy to talk through your individual situations and see if our teams can be helpful. So with that, thank you very much. Enjoy the rest of your day. Hopefully we uplifted you a little bit, and we will send out the slides and video as soon as we can. Thanks again.
Thanks, Vitaly, for putting this all together. Appreciate you.
Thanks.